All right, dear students, in this lecture, we are going to do another important standard for your exam. The name of the standard is the non-current asset held for sale and discontinued operation. The number of the standard is IFRS 5, and I'm your tutor, Rashid Hussain. So the first thing you need to understand regarding this standard is these are the non-current assets. Let's assume we were having some assets for the business use, like for use in the production, or for example, for giving the services, for administrative purpose, for rental to others, whatever it was. Let's assume we were having some assets for the business use. Now, the assets which are for the business use should be classified in IAS 16, the property, plant, and equipment. And we have studied that standard in quite detail. By any reason, now you are selling those assets. Let's assume you were having a machinery which you were using in the production. Now the updated version is available in the market, which you are thinking to buy, and you are planning to sell your previous or existing machine, which is classified in IS 16 property, plant, and equipment. So when you have decided to sell the machine, now you will not be using that thing in the production. And by definition, which you have studied in your earlier accounting paper, that we are going to classify anything in the non-current asset whose benefit is going to be for more than 1 year. You are using it for more than a year, for more than one accounting period. That's why you classify that thing in the IAS 16. But now you have planned, now you have decided to sell it. And when you have decided to sell it, hopefully you want that asset to be sold within 12 months. In that case, when you have decided to sell the asset, it does not meet the definition of non-current asset now. So it should be transferred from the non-current asset to the current asset. Because previously you were using it, and the intentions were to use it for more than one accounting period. That's why you were actually keeping it under the non-current assets. But now you have decided to sell that asset, and when you have decided to sell that asset, you want that this asset should be sold as soon as possible. It should be sold within 12 months. The benefit it should generate for you should be quick, now within 12 months. So then it should be classified in the current assets. So remember the basic concept that the non-current asset held for sale means that previously you were using that asset and now you have decided to sell it. So it should be moved from the non-current asset to the current asset. But again, there is a criteria for that, which we are going to study shortly. And then you have the discontinued operation, and this is the disclosure for the discontinued operations, this sort of disclosure. Let me give you an example. Say I have the money, surplus money, and I want to invest that money somewhere. I decided to buy the stocks of a company, the shares of a company. And I just look at the financial statements of, say, let's assume ABC company, and I saw their assets, I saw their liabilities, and then I saw their revenue and the profits. And based on their financial performance and financial position, I took a decision to buy the shares of this company. Now I became the shareholder. In the next year, I observed that there is a drop in the revenue and the profits. And also there is a reduction in the number of assets, reduction in the value of the assets. And then I questioned this thing, that why there is a drop in the revenue and the profits and the decline in the assets. And I got a reply that, sir, there were some assets in the last year which we decided to sell. and now they have been sold. So because they have been sold, that's why you are looking at a reduction in the number of assets and also a decrease in the revenue and the profits. Then I said to them that if you decided to sell those assets, then why you won't give a separate disclosure for those assets, that these are the assets which will not be available in the next year. And this is the chunk of income, this is the chunk of profits which is coming from those assets which will be sold, and this profit will not be available until and unless these assets are replaced. Obviously, you will be questioning this thing, that why you didn't give the disclosure for those assets which were about to be sold. Why you didn't separate the profit which was coming from the assets which will be sold and now it will not be available in the next year until and unless those assets are replaced by some new assets. So again, this should be a question of the average shareholder. That's why IFRS 5 is here. IFRS 5 is going to make sure that whenever any asset is going to be sold, it will not be the part of the non-current asset. It will be shown under the current assets as held for sale, so that the shareholders can see that, okay, these are the assets which are now going to be sold. Because when they are part of the non-current asset, obviously there is the expectation of the shareholder that these assets will earn something for the entity when they will be used in the business. But when they are classified under the current assets, it is quite clear that now these assets will be realized. These assets will be sold rather than used. And when you are giving a separate disclosure and you are keeping the profits of those assets separate from the rest of the assets, it is a clear indication that this chunk of profit is coming from those assets which will be now sold. And it's not only about assets, it can be a subsidiary which you are going to sell. We'll be going to study it by the end of this lecture. So that is why the IFRS 5 is here. That is why there is a need of a standard, so that it covers all these aspects which I have discussed in my example. Now, what IFRS 5 will be covering? IFRS 5 covers the measurement, the presentation, and the disclosure of the non-current assets and disposal groups of an entity. The presentation and the disclosure of the discontinued operations. So the assets which are going to be sold, how they will be measured, how they will be presented, how they will be disclosed, all these things will be covered by the IFRS 5. And not only about the single asset, it can be a disposal group. That means the group of assets when you're selling it. Say, for example, you're selling a factory. Within the factory, there are huge number of assets. So it's not a single asset, it's a cash generating unit. It's a group of assets that is going to be sold. So there's a definition written on the right hand side. The disposal group is a group of assets to be disposed of that you are going to sell by sale or otherwise together as a group in a single transaction, and liability is directly associated with those assets that will be transferred in the transaction. Not only assets you are transferring, it's the liability which will be transferred as well. So this is the scope of the IFRS 5, that the assets which are going to be sold will be covered under IFRS 5. Now again, the definitions. IFRS 5 non-current asset held for sale and discontinued operations says that a non-current asset or disposal group should be classified as held for sale if its carrying amount will be recovered primarily through a sale transaction rather than through continuing use. And if you now recall my example, which I gave a bit earlier, that you were having a machine which you were using for the production, and obviously it was used to make some units, and then those units were sold in the market, it was generating revenue for the entity when you were using it, and now it will be sold, so its value will be recovered through a sale transaction rather than through use. Let's say I have a car. I can either use it and generate revenue from it by using as a cab, or I can sell it and realize the value. Again, both are the benefits for me. Both will generate the inflows, one through use and the other through sale. So when we are talking about the IFRS 5, these assets will be sold rather than being used. And now the inflows will be generated from the sale rather than through use. And the disposal group may be a group of the cash generating units, a single CGU or a part of a CGU. So I've already told you that this can be a single asset or it can be a group of assets. Now, why there is a criteria for classifying an asset as held for sale? There's a strong reason for it. Let's say there are some assets which the entity at the start of the year classifies as the asset held for sale. When they are being classified as held for sale, they will be moved to the current assets, and we know that the current assets shows the liquidity of the entity. The current assets are also known as the liquid assets, that these assets will be easily convertible into cash. Like the cash itself, it's a cash. Inventory will be sold, the receivables will be collected, and even when you are classifying an asset as held for sale, there is an assumption that this asset will be sold within 12 months and it will bring the inflows to the entity. So there can be a manipulation by the entity that at the start of the year, what they can do, they classify their assets as held for sale and they move those assets from the non-current asset to the current assets. And it shows that now the liquidity has improved. And once the year has passed, by the end of the year, they say, no, we have changed our plan. Now we will not be selling these assets. So it can be a source of manipulation that they, at the start of the year, is decide to sell the asset and they move it to the current asset. And by the end of the year, they change their plan and then again they move it to the non-current asset. So this can be a dramatic situation. So to avoid that situation, the standard says that you have to meet a criteria before you classify an asset as held for sale. And the mnemonic or the abbreviation to remember it is the sale. The first thing is the sale, and then it can be extended into a sale CPU. Remember the CPU, the desktop or the tower computer we used to have in our childhood. So SALE CPU. First of all, the main criteria is SALE, the sale one. And all of these will make sense. And let's read one by one. The first thing is the sale is highly probable. The sale is highly probable, that obviously there are chances that this asset will be sold. And highly probable means that there are significant chances, the likelihood that this asset will be sold. And again, the intentions of the management depends as well. The sale is highly probable. Like this, there should be an irrevocable and irreversible intention. Irrevocable and irreversible means that once you have decided to sell the asset, there's no way back. The second criteria is the item is available for immediate sale in the present condition. Like say, for example, I have a machinery and I'm using it, and then again, I'm saying I'm going to sell it. So when I'm using it, it shows that I do not have any intention to sell it. If I have uninstalled that thing and now I'm not using it, It is available for immediate sale. That shows my intention to sell it. And then the third criteria is an active program to locate a buyer has been initiated. Now, an active program means that you have marketed that asset in the active market. Nowadays, we have many sources like the website where we can put an ad regarding those assets, like that we are going to sell it, and then the buyers can approach us through through those applications and through those websites. Nowadays, it is quite easier. So if you have marketed that asset and now you started receiving some offers regarding that asset, then that means you have done your part regarding the sale of that asset. And then the last thing in the first four things is the sale is expected within 12 months, that the asset will be sold within 12 months. So the sale is highly probable. That means you are actually committed to sell the asset. The sale is highly probable that there are more chances that the asset will be sold. Asset is available in its present condition for sale, and you have started, marketing it. You have started marketing regarding the sale of that asset, and now you've started receiving the offers, and you're applying to those offers as well. And the sale is expected within 12 months. This is the main criteria you should remember. That if all of this criteria is met, then you will be able to classify your asset as held for sale. And then the extended part of it is that management is committed to a plan to sell the item. As I've told you, that it should be an irreversible or irrevocable thing. Irrevocable means that you are not going to reverse your decision, and there's no step back, there's no way back. Another important thing is the item is being actively marketed at a reasonable price in relation to its current fair value. This shows your intention as well. And this has a direct link with the sale is highly probable. Let's assume I'm selling my car and the worth of my car is 2 million rupees. And I have floated the price in the market 3 million. Now, the fair value of my car is 2 million and I have put an ad for 3 million. That means I'm not serious in selling my car because I have put a price which is impossible to achieve. And the last thing is it is unlikely the plan will change significantly or withdrawn. So you can see the last three gives the same meaning. So that is why I was saying that the first four things should be remembered. SALE. The sale is the main criteria, and the rest is actually the description of the above one, or you can say the explanation of the above one. So if this criteria is met, then you will be able to classify your asset as held for sale. All right, now we have the measurement of the asset and the disposal group held for sale. Let me just write the double entry first, that if the criteria is met, which we have discussed in the previous slide, then you will be removing this asset, from non-current asset, right? This is the first thing. The second thing is that you will be recording this asset in the current assets. All right, that's fine. So what you're going to do is debit the current asset. And remember, within the current asset, we'll be making a separate head for it, which is held for sale asset. The credit will be the non-current asset because you are going to remove it. So let's assume the credit non-current asset was for 100. And now you are going to record it at 80. Why we are recording it at 80, we'll be discussing it in a while. So you are de-recognizing the non-current asset and the value was 100. Now you're recording it as current asset at the worth 80. The debit entry will be to the profit or loss, and this represents an impairment of the asset, which is the fall in the value of the asset. Now that means we will be recording the asset in the current assets at lower of what? Its carrying amount, which is the carrying value. Carrying value means the book value, whatever the value in the books is, and then the fair value less cost to sell. Fair value less cost to sell. The fair value means the market value, and the cost to sell means is actually the additional cost which will be incurred to sell that asset. So you're going to deduct it from the fair value. The net price, which resembles NRV, will be taken. So you are going to take the lower of its carrying value and the fair value. And remember one thing, this carrying value should not be this at the start of the year, should not be something by the end of the year. It should be at the date when you are classifying an asset as held for sale. So there may be a situation where you have the carrying value at the start of the year, but you are classifying this asset midway through the year. So you have to calculate further depreciation for it and take the carrying value at the date when you are classifying an asset as held for sale. And this carrying value will be compared with the fair value less cost to sell. And if there is a difference, like the carrying value is more than the fair value, if the carrying value is more than the fair value, then this will give rise to the impairment, which will be recorded in the profit or loss. If there is no revaluation surplus, first of all, you have to revalue it at the classification date. And if there is any impairment, and also this asset was previously revalued, first of all, you have to de-recognize that, as we have discussed that thing in the IAS 16, and then we'll move further. So items classified as held for sale should, according to IFRS 5, be measured at the lower of their carrying amount and the fair value less cost to sell. This is what I've written on the top right side. Where the fair value less cost to sell is lower than carrying amount, the item is written down and the write down is treated as an impairment of the impairment loss, which I have discussed over here, if the carrying value is more than the fair value or the fair value is less than the carrying value. If a non-current asset, this is a very important point, I'm just going to mark it important. If a non-current asset is measured using a revaluation model, and we know that revaluation model, we take the asset from the carrying value to the market value, the revalued amount. If a non-current asset is measured using a revaluation model and it meets the criteria to be classified as being held for sale, it should be revalued the fair value immediately before it is classified as held for sale. Like, for example, we are classifying an asset as held for sale on 1st June. Before doing that, we are going to revalue it. We are going to take the carrying value to the revalued amount. It is then revalued again at the lower of the carrying amount and the fair value less cost to sell. The difference is the selling cost, and these should be charged against the profits in the period. Now, this is something important to understand, and this is the logical as well. Now, the assets which are on the cost model, there is no need to revalue those assets. Just you have to see the difference between the carrying value and the fair value. Now we are particularly talking about the assets which are on the revaluation model. So when you are having an assets which are on the revaluation model, first of all, you are going to revalue it before they are being classified as held for sale. Once they are brought to the revalued amount, then they are going to be compared with the fair value. Now you will be thinking that when we have already revalued it, Now they are on the fair value. So how we can compare the carrying value, which is a fair value because we have revalued it, to the fair value less cost to sell? Your point is valid. When we have already revalued it, that means the carrying value resembles the fair value. And when we are comparing it with the fair value less cost to sell, the only difference is going to be the cost to sell. So this is what written over here is. The difference is the selling cost. Difference is the cost to sell only because we have already brought the asset on the fair value. So this carrying value represents the fair value. And when we are comparing it with the fair value less cost to sell, the only difference is going to be the cost to sell, which should be charged against the profits in the period. That means should be recorded in the profit or loss. When a disposal group is being written down to the fair value less cost to sell, the impairment loss reduces the carrying amount of asset in order prescribed by IAS 36. And IAS 36 states that it should be first allocated to the goodwill and then other assets on the pro rata basis. So this second point is very important. When you have the assets which are on the revaluation model, immediately before classifying it as held for sale, you have to revalue it. When you are going to revalue it, now it is already on the fair value. So this carrying value represents the fair value. And then when you are comparing it with the fair value less cost to sell, the only difference will be the cost to sell, which should be recorded against the profit. That means in the profit or loss. And the last point, which is very important, is an asset held for sale. Once you have classified as an asset as held for sale, once it is in the current asset, it should not be depreciated. It should not be depreciated. All right, now we have an example. So on 31st December 2003, make sure you just remember the criteria, which is sale is highly probable, asset is available for immediate sale, locating a buyer, an asset is expected to be sold within 12 months. And then the extended version of it is that there should be an irrevocable intention, actively market at a reasonable price, and the decision is not reversible. On 1st December 2003, a company became committed to a plan to sell a manufacturing facility. So now it's a manufacturing facility, the full facility. That means it's a disposal group, and has already found a potential buyer. So that means the two conditions are already met by the first statement, that they are committed to sell the asset. The first condition is being met, and they have the buyer as well, which means the other condition is met as well. The company does not intend to discontinue the operations currently carried out in the facility. That means one of the major criteria is not met, that the asset should be available, the asset should be available for immediate sale. But now this does not met because the company does not intend to discontinue the operations. At 31st December 2003, there's a backlog of uncompleted customer orders. The reason is that they're having some unfulfilled orders which they have to complete. The subsidiary will not be able to transfer the facility to the buyer until after it ceases to operate the facility and has eliminated the backlog of uncompleted orders. They will not be able to sell the asset unless they have completed all the orders. And this is not expected to occur until spring 2004. So can the manufacturing facility be classified as held for sale? No, it cannot be classified as held for sale because it is not available for immediate sale in its present condition, although the other criteria are being met. Now we have subsequent gains. The first thing to remember is that usually when we have assets in the current assets, we do not revalue those assets. Like, have you ever revalued the inventory? No, because it has its own criteria. that it should be recorded at lower of cost or NRV. So we never apply any revaluation or even the impairment principle to the inventory because it has its own criteria of the valuation. Similarly, we do not apply the impairment criteria on the receivables because they are treated as the financial assets and it is being covered under a separate standard. So we do not apply that thing to the receivables as well. Then the cash can never be impaired, although it has a concept of the time or value of money, but that is not associated with the impairment. So usually we do not revalue or test the current assets for impairment. But there can be a situation specifically for the asset held for sale. Like we were having a non-current asset and the value was 400. Then we classified this non-current asset to the current assets. And at that time, its value was 80. So we took the lower of between 100 and 80. And then 20 was charged to the profit or loss against the impairment. Now, this asset held for sale is recorded in the current assets. Let's assume we classified this asset at the start of the year, which was 1st January 2020. And now we are preparing the interim financial records. Let's assume that we are preparing interim records, interim financial statements during the year, like quarterly, semi-annually. And on 1st June or 1st July, this current asset, which we classified as held for sale, now the fair value of this current asset is, let's assume 120. Now the question is, can we take this current asset, which was worth 80 at 1st June and 120 at 1st July, can we take this asset held for sale from 80 to 120? This is the question. So what does the standard says regarding this thing? A gain can be recognized for any subsequent increase in the fair value. Subsequent increase means after classifying that asset as held for sale, but not in excess of the cumulative impairment loss that has already been recognized, either when the asset were written down to fair value fair value less cost to sell, or previously under IAS 36. So what you can do is you can only reverse this impairment of 20 which you have charged, and you cannot take the asset more than this value. So what we'll be doing, we can debit the asset held for sale by 20, and we can credit the profit or loss to reverse the impact of that impairment, but not more than that. So you can only reverse the impact of the impairment and you cannot take the asset beyond that. So this is the important concept that you need to remember. All right, now we have another example. HISOP is preparing its financial statements for the year ended 31st December 2007. On 1st December 2007, the entity became committed to a plan to sell a surplus office property and has already found a potential buyer. All right, they are committed to sell the asset and they have the buyer as well on 1st December 2007. So the date is important. On 15th of December 2007, a survey was carried out and it was discovered that the building had dry rot and substantial remedial work would be necessary. There's a problem in the building and they need to fix it. The buyer is prepared to wait for the work to be carried out, but the property will not be sold until the problem has been rectified. So this is not expected to occur until summer 2008. So that means again the property is not available for the immediate sale. So it cannot be classified as held for sale. But if the situation is different, like for example, if the buyer says, okay, sell me the property even in this condition, I'll fix it myself. Now that is a different situation. That will be an immediate disposal rather than classifying it as held for sale. So you are not classifying it as held for sale because it's not available in its present condition for sale. Maybe once they have fixed it, maybe they change their mind that okay, now because we have fixed it, let's just use it themselves. So IFRS 5 states that in order to be classified, a property as held for sale, it should be available in its present condition for sale. The property is not available, therefore the property cannot be classified as held for sale. Then we have another example. A subsidiary entity B is for sale at a price of 3 million. Okay, fine. Now it's a subsidiary itself, not a single asset, a disposal group. There has been some interest from prospective buyers, that means potential buyers, but no sale as of yet. One buyer has made an offer of 2 million, but the directors of HISOP rejected the offer. The directors have just received advice from their accountants that the fair value of the business is 2.5 million, and they have decided not to reduce the sale price of the B at the moment. So that means it is being marketed more than its fair value. So when you are marketing any asset more than its fair value, then there are less chances that anyone is going to purchase that because nobody is mad that they will be buying the asset more than its fair value. So can the subsidiary be classified as held for sale? No, it should not be classified because you have advertised it more than its fair value. And in order to classify it as held for sale, you have to reduce the value to its fair value. Then it can be classified as a property or a subsidiary held for sale. Then you have another example. On 1st January 2001, AB acquires a building for 200,000 with an expected life of 50 years. All right. So they bought the asset on 1st January 2001. It's a building, 200,000, expected life of 50 years. So you can calculate the depreciation of it. 200,000 divided by 50. Let me do it myself as well. So 200,000 divided by 50. It gives you 4,000 as a depreciation. 4,000 per annum. All right. On 31st December 2004, AB puts the building up for immediate sale. Okay, it's 31st December. So how many years? 1, 2, 3, 4. So you can calculate the carrying value because we need the carrying value at the date when it is being classified as held for sale. So carrying value, how much is the depreciation? Multiply by 4, 16,000 and minus 200,000. So 1,84,000 is the carrying value. Sorry. The cost to sell the building are estimated at 10,000. We know we have to take now the fair value less cost to sell. Required, outline the accounting treatment of the above if the building had a fair value. So there are two situations for it. We're going to take two separate situations. This is the A situation, this is the B. So in the A situation, the fair value is 2,20,000. Obviously, we are going to deduct the cost to sell from it, which is 10,000. And then it will give you 2,10,000. The second situation in which we have the fair value, which is 1,10,000. And then you have the cost to sell, which is 10,000. And then you have 100,000 over here. So in the A example, you have 2,10,000. In the B example, you have 100,000. We know that we have to take the lower of its carrying value and the recoverable amount, which in this case is the fair value less cost to sell. So if you see the first case, the carrying value is 1,84,000 and the fair value less cost to sell is 2,10,000. The carrying value is already lower in the first case. So we'll stick to the carrying value and we'll keep recording that asset at 1,84,000. In the second case, we see the carrying value is 1,84,000 and the fair value less cost to sell is 100,000. So in the second case, we will have the impairment loss of 84,000, which will be recorded in the statement of profit and loss. So in the first case, we'll keep recording that asset at 1,84,000 because the carrying value is lower and the fair value less cost to sell is more than the carrying value. In the second case, there will be an impairment loss of 84,000, which will be recorded in the profit or loss. Now we have another example, which is again a very important example. And remember the principle that if you are having an asset which is on the revaluation model, you have to revalue that asset immediately before classifying it as held for sale. Then the only difference is going to be the cost to sell, which will be recorded in the profit or loss or against the profits. Nash purchased a building for its own use on 1st January 2001 for 1 million and attributed it a 50-year useful economic life. Nash uses the revaluation model to account for the building. Now we can calculate the depreciation. So it's 1 million, that is the 10 lakh, divide by 50. So the per annum depreciation is 20,000. So 1 million divide by 50. So the depreciation per year is $20,000. On 31st December 20x2, this building was revalued to 1.2 million. Now we know when we are revaluing it, we have to take the carrying value at the revaluation date and then the revalued amount. So what should be the carrying value? It is 1 million. Now, obviously, when you have 1 million minus 40,000, it is going to be 9,60,000. And this is 12 lakh. So the difference between the carrying value and the revalued amount is going to be the revaluation gain. So 12 lakh minus 9,60,000. The 2,40,000 is the revaluation gain, and that will be recorded in the other comprehensive income and the revaluation surplus. Now this property is going to be recorded at 1.2 million and will be divided at remaining useful life, because we remember the IAS 16 that after revaluation, depreciation should be recorded on revalued amount and remaining useful life. So the revalued amount is 12 lakh and the remaining useful life is 48 years. So 12 lakh divided by 48, it is going to be 25,000 per annum. Now the depreciation. On 31st December 20x3, which is again after 1 year. Now, after 1 year, the carrying value is going to be how much? It is 12 lakh minus 25,000, which is 1,175,000, 11,75,000. On 31st December 2003, the building met the criteria to be classified as held for sale. its fair value was deemed to be 1.1 million, and the cost necessary to sell the building were estimated 50,000. Now we already know that Nash uses the revaluation model. So first of all, we have to take this carrying amount to the revalued amount. Now, before classifying it as held for sale, you have to revalue it. So the carrying value is 11,75,000, and the revalued amount is now 11 lakh. Accordingly, there is the revaluation loss of 75,000. And this revaluation loss of 75,000 should be recorded against the revaluation surplus we were already having, because we know that if we are already having a revaluation surplus, first of all, this revaluation loss should be deducted from it. Once it is being revalued, now the carrying value resembles the revalued amount. The carrying value and the revalued amount is 11 lakh. Now we have to see the fair value less cost to sell, which was 11 lakh minus 50,000, because the 50,000 is the cost to sell, and it will be 10 lakh 50,000. Nash does not make a reserve transfer in respect of the excess depreciation. Discuss the accounting treatment of the above. Now this 50,000, which is the difference between the revalued amount and the fair value less cost to sell, will be recorded in the profit or loss. So you see the answer we have over here is, first of all, we have calculated this 9,60,000, which we already did. And then you compare it with 12 lakh. The 2,40,000 is a revaluation gain, which will be recorded in the comprehensive income. And then the depreciation will be recorded on the revalued amount and remaining useful life. So 25,000 is the new depreciation. It will give you the carrying value of 11,75,000. Before classifying it as held for sale, we are going to revalue it. And this gives a revaluation loss of 75,000, which will be charged against the revaluation gains, because we already have that. The building will be then revalued at the fair value less cost to sell. Therefore, the asset must be reduced in by a further 50,000, and this loss is charged to the statement of the profit or loss. This is what we studied earlier. Now we have the non-current assets to be abandoned. Like whenever you will be using those assets, it will be abandoned but will not be sold. So the non-current assets to be abandoned are not classified as held for sale, since their carrying amount will be recovered principally through the continuing use. Like when you are going to abandon it, you're not selling it. So when you are not selling it, it does not meet the criteria to be classified under IFRS 5. So this includes the non-current asset that are to be used to the end of their economic lives, that we will be using it until and unless they are finished, and closed rather than sold. Will discontinue using it and will not be selling it. So the assets which are to be abandoned and not sold does not comes under the scope of the IFRS 5. So the non-current assets which we are not going to sell, and we'll continue using it till their economic life, unless and until they are being finished, and we'll not be selling it. We'll be just closing the use of that asset rather than selling it. Then those assets should not be recorded as held for sale under IFRS 5. So this is the important thing you need to remember. Okay, this is another example. You can do it by yourself. And then we have the presentation in the statement of financial position. We know that once the asset is being classified as held for sale, you're going to de-recognize it from the non-current asset and will be recording it under the current asset. So IFRS 5 states that the asset classified as held for sale should be presented separately from other assets in the statement of financial position. We already know that. The liabilities of the disposal group classified as held for sale should be presented separately from other liabilities, because when we are disposing a group of assets or a disposal group, and if it has liabilities attached to it, so not only we transfer the asset, we also transfer the liabilities associated with it. So just like we are disclosing the assets separately, the liability should be uh, disclosed separately as well. So then there's a question which was even asked by uh, a student, that changes to a plan of sale. Let's assume we are having an asset. We decided to sell it by the start of the year. We were actually committed to sell the asset, but something may happen after 12 months that we have to now see whether it should be classified now again as held for sale asset, or again we should record back into the non-current asset. So whenever there is such situation that the asset is not being sold within 12 months, the first thing you need to see is whether the management is still committed to sell the asset. Like they decided by the start of the year, 12 months has been passed, and now they're still willing to sell the asset. And the second thing is that the factors due to which the asset is not being sold were not under the control of the management. Like say, for example, there can be an economic recession. Previously, there were buyers available for it, but now there is an economic recession. No one is buying. Usually, people do not buy in the economic recession. So, due to that economic recessions, or for example, due to security situations, for example, due to some vacations, it can be any reason. The factors due to which the asset is not being sold were not under the control of the management. If that is the case, then the management can continue to record the asset under the current asset with additional disclosure. That means you have to provide additional disclosure. You have to explain the situation why the asset is not being sold within 12 months. But if the criteria is no longer met, and that situation is other than the above which I have described, then the entity must cease to classify the asset or disposal group as held for sale. Now you have to remove it from the current assets. And you are going to record that asset again in the non-current asset at the lower of its carrying amount before it was classified as held for sale, adjusted for any depreciation. That simply means if this asset was not classified as held for sale, what would be the carrying value? That carrying value. And its recoverable amount at the date of the subsequent decision not to the sell. That means you're going to compare the carrying value had the asset not been classified as held for sale. Say, for example, it was a duration of 12 months and you have not charged depreciation. So charge it and then calculate the value had the asset not been classified as held for sale, and compare it with the recoverable amount at the date of subsequent decision not to sell. Whichever is lower, it should be recorded at that amount. Now, the last thing in the standard is the discontinued operation, which is again very important. I have already given you the flavor of this at the start of the lecture. That if you are having assets which you have classified as held for sale, if you are having a subsidiary which is even bought for the resale purpose, and if you have bought it for the resale purpose, acquired it for the resale purpose, that means it will be sold within 12 months. Or for example, assets which you have classified as held for sale. So the profit from those assets which have been classified as held for sale, or for example, a subsidiary which is going to be sold, should be disclosed separately as a discontinued operation. Because it is very vital information for the shareholder. They should know that this portion of profit is coming from those assets which will not be available in future. This portion of profit is coming from a subsidiary which will be sold in the future. So discontinued operation, a component of an entity that either has been disposed of or is classified as held for sale. So for the shareholders, what you are going to do is you make the separate disclosure for it so that they can understand that, okay, this portion will not be available in the next or the prospective accounting period. So what we are going to disclose on the face of the statement of profit or loss and other comprehensive income, a single amount comprising of post-tax profit from discontinued operations. That means you are going to divide the profit into two things: profit from continued operations and profit from discontinued operations, so that the shareholders can understand regarding the discontinued assets. And on the face of the financial statement, in the notes, the revenue expenses or the pre-tax profit or loss of discontinued operations, the gain or loss recognized on the measurement of the fair value less cost to sell, the net cash flows attributable to operating, investing, and financing, because it is related to notes and the cash flows and things like that. The last thing you need to remember regarding every standard is the disclosure. And I, I always tell you to just give it a read, because it is important for the notes of the financial statements. You should understand what we are going to disclose. So in the period in which a non-current asset or disposal group has been classified, then it must disclose the description of the non-current asset, or if it's a disposal group, a description of the facts and circumstances of the sale or expected sale, any impairment losses or reversals which are being recognized in case of subsequent gains. So this is all about IFRS 5.